What's going on, guys? Today we're going to be understanding reversal patterns and how we can use them to our advantage to spot price movement that's going to break out either to the upside or the downside just from understanding these simple patterns. So let's jump right into it and start off with the first one. What is a bearish double bottom? A bearish double bottom is an extremely bearish reversal pattern that forms after a stock reaches its peak two consecutive times with a moderate pullback between the two highs. It is a confirmed pattern once price falls below the support level of the last low. So let's take a look at this. We see down here how we have our first top, pull back down to support, rally up, second top, pull back down to support, and we did not break this support level, right? So we pushed back up. Boom. That's a failed double top. Now we have our peak, a second peak. Boom, we break that support level, gap down. Now that support became resistance and the trend reversed. So these are actually very, very common. What is a bullish double bottom? A bullish double bottom is an extremely bullish reversal pattern that forms after a stock reaches its dip two consecutive times, finding support with a moderate rally to resistance and then a pullback to support again. It is a confirmed pattern once price rallies again and breaks above the level of resistance on that last rally peak. So what does this mean? As we can see, this first figure right here is the last one that I just showed you, which was the double top. Now we're looking at the double bottom, which is basically the invert version of the double top. So now we can see the double bottom actually occurs after a downtrend, right? We hit that support, rally up, hit that resistance, which is the neckline. Boom, support. Again, we break out of that resistance and we continue upwards. So if you wanted to enter in this position, you'd put your entry here, your stop here, your take profit over here, and opposite for the last pattern. As we can see on the chart, same exact example. Support, resistance, support, boom, breaks resistance and continues up. So a bearish head and shoulders pattern. The head and shoulders appears above support with three peaks. The outside two peaks are close in height, also called the shoulders, and the middle is the highest peak, which is the head. This occurs after an uptrend and indicates a reversal to the downside if confirmed with a breakout of the neckline, also called support. So before I explain this pattern, I want you guys to know all of these patterns, whether they're continuation patterns, reversal patterns, triangle patterns, flags, pennants, whatever it is, all these patterns are more valuable and more efficient, let me say, in longer time frames. They still work on shorter time frames as weeklies, dailies, intraday charts, but they hold less significance than they would if it was a longer time frame, such as 6 months, a year, longer than that, etc. So now, with the bearish head and shoulders pattern, this occurs after an uptrend and indicates a reversal, right? So we see we have our shoulder pull back down to support, our head pull back down to support, our shoulder, which is equal with the last shoulder, or a little bit higher or a little bit lower, and then boom, we break that support to the downside and create that new resistance. Its cousin is the bullish inverted head and shoulders pattern, right? This is basically the same pattern, except opposite. This occurs after a downtrend, right? So we basically have our left shoulder pop down here, rally back up, hit resistance, pull back down, create support, pull up, hit resistance, pull back down, equivalent with the left shoulder, either a little less or a little more, and then we break that resistance and create new highs, as we can see up here. Shoulder, head, shoulder, break. So if we wanted to enter this, we would put our buy, our entry would be right here, stop loss below the shoulder or the head, wherever your risk is, all right? So now a bearish rising wedge. The rising wedge pattern forms when the market makes higher highs and higher lows with a contracting range that gets smaller and smaller. This pattern indicates a downside reversal if broken. So as we can see, we have our trend line, right, and our other trend line, right? They're contracting, getting smaller and smaller. So we can see price tries to rally up, fails to create a newer high, hits support. Rallies up, creates that higher high, but we pull back down to support. It's a very narrow trend. Pulls back down to support, rallies back up. We can't break this resistance, right? And what happens? Boom, price breaks. So how do we measure where like the projected breakout range of this triangle would be? we take the wedge height. So we take a triangle from top to bottom and we measure that and project it over to the breakout area. And that's how we get our entry and our profit target, right? So we could see over here also the resistance level slopes up and the support level slopes up as well. And we have either breakout to the upside or the downside, but most likely the downside, right? Because these are reversal patterns. The bullish falling wedge, the opposite of what I just showed you. The falling wedge pattern forms when the market makes lower lows and higher lows with a contracting range that gets smaller and smaller. This pattern indicates an upside reversal if broken. So as we can see, same concept. Price falls down to falling support, boom, rallies up, resistance. Same concept, it's getting smaller and smaller and smaller. See the lower high, lower high, lower high, boom, breakout to the upside. So the bearish triple top and bullish triple top are pretty much similar to the head and shoulders in the sense of it's a reversal pattern, but it's not head and shoulders. So now it's similar to the head and shoulders pattern, except in this pattern, all peaks or dips are almost equal in height or depth, right? As long as the middle peak does not exceed the outer peaks or dips, it is not a head and shoulders pattern. So a lot of people mistake these triple tops, triple bottoms for head and shoulders. But the only way it could be a head and shoulders is if this middle peak exceeded the shoulder on each side, right? Same here. This dip would have to exceed the shoulder on each side, but they're about equal or a little less than. So that's why it's a triple top. We could treat this the exact same way as the double bottom or the double top. So let's get into the three types of triangle patterns. So before we jump right into this, I want to let you know that these are a form of continuation patterns, but they can break out in either direction. So that's why I'm adding them onto here. I am going to be doing another video on continuation patterns, but for now, we're going to stick to the triangle patterns and the reversal patterns. So the symmetrical triangle is very, very, very common. So a symmetrical triangle has two converging trend lines with equal slope containing price equally on both sides. This is more of a neutral pattern that is seen often. It also represents a period of consolidation before the price is forced to break out or break down. So now we can see price is bouncing, 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 and we're either going to have a breakout to the upside or the downside. But there's one thing I want you guys to know about these triangle patterns that I'm about to show you. They need to have a minimum of 5 points to be a confirmed triangle of some sort, right? We have our starting point 1, 2, 3, 4, 5, and then we have our breakout, right? And if it was another triangle, it would be the same thing. We need 5 points of confirmation to be a triangle. Well, to be a specific triangle. In this case, a symmetrical triangle. So an ascending triangle. An ascending triangle mainly appears in uptrends, has a horizontal line drawn along the swing highs and a rising trend line along the swing lows. Triangles are known for breakouts. The breakout can occur to the upside or the downside. They are often called continuation patterns since the price will typically break out in the same direction as the trend that was in place just prior to the triangle forming. But anything can happen, right? It also provides a clear entry point, profit target, and stop loss level. So why I love to incorporate triangles into my trading plan is simply because they're very easy to trade, right? So with an ascending triangle, it's often known for its breakout to the upside, right? Because it continues the trend, the uptrend, and the ascending triangle forms. So that doesn't mean that it always will break out to the upside, but it has a high probability of breaking out to the upside. So if I were to trade this, I would enter at the breakout, right, on high volume, and I would place my stop loss just below this sloping up support, and my target profit would be from bottom to the top of the triangle. I project this range up from the breakout, and that's where my target profit would be. So now if I'm trading the descending triangle, I could play this as well, but this is what I would be playing from the short side rather than the long side, right? So a descending triangle is bearish. It is made up of a descending trend line that connects lower highs and a horizontal trend line that connects the lows. Breakdowns usually occur below the lower support trend line. It shows the downward momentum is building up. So basically, this is going to occur in a downtrend, right? Well, you mainly see it in a downtrend. So let's say the downtrend is happening, boom, boom. Now we enter into this phase of consolidation where price isn't really going anywhere, right? We're not making newer highs, we're not making new lows, we're just moving in the triangle. So price is most likely, high probability, to break out to the downside and continue the trend. But doesn't mean it can never or won't break out to the upside. You just have to be cautious and react to what the market gives us, right? So this is what you would want to play from the short side. You'd want to enter here, stop loss here, take the width of the triangle and project it down from the breakdown, and that would be your target profit area. Thank you guys for watching. Have a blessed trading week, and don't forget to hit the like, subscribe, thumbs up, follow me on Instagram at Billy Talks Business and K Capital. Take care, guys. Have a blessed week.